Good morning, everyone. In this video, I shall be discussing about fundamental analysis. Uh, this with this we start with unit 3. So let's begin. So basically, there are various ways to understand the market prices of securities. So according to financial analysts or analysts, they adopt two methods. One is technical analysis and one is fundamental analysis. So when a particular investor analyzes the past records of a particular share, the share prices of a particular company from the past 5 years and then tries to predict the future price, that is basically related to technical analysis. That investor tries to develop charts and then tries to predict the future price. And there is one more method through which analysts or investors can predict or assume the price in which direction it could be going. That is fundamental analysis, whereby the intrinsic value of the share is evaluated, and thus then it is understood whether the share should be sold or bought. In fundamental analysis, the investors try to make use of the various factors that affect the share prices. It can be any factor in the economy, it can be any factor in a particular sector, or it can be any factor within a particular company. So that is why it's termed as economy analysis, industry analysis, and company analysis. In short, we term it as EIC. So before going into EIC, let's just understand what is the concept of fundamental analysis. So it is the assumption that the share prices depend upon the future dividends expected by the shareholders. So always you find that when the shareholders expect or investors expect that the dividends would increase. So when I talk about dividends, actually what is happening, the profits are increasing, and from the profits, the company is able to give more dividends to the shareholders, right? So when it is assumed that the share prices is getting affected by the increase in dividends in future by the shareholders. So the present value of the future dividends can be calculated by discounting the cash flows at an appropriate discount rate and is known as intrinsic value of the share. So please remember this point. The intrinsic value of the share is the present value of the future dividends that can be calculated by discounting the cash flows of by an appropriate discount rate. So future dividends means the expected dividend rates or the expected dividends that are to be received by the shareholder from the company are discounted by a discount rate. This discount rate is nothing but sometimes it is the expected rate of return or any other rate which is considered, or the opportunity cost which is considered to calculate the present value. I hope you understand how to calculate present value. So this present value of future dividends discounted by a discount rate uh, is known as the intrinsic value of the share. So this intrinsic value depicts the true value of the share. So it is based on the intrinsic value and the market price of the share. The fundamental analysts try to sell or buy shares. So a share that is priced below the intrinsic value must be bought, while a share which is above the intrinsic value must be sold. So this is basically, so if you look into the market and find that after calculation you find that the intrinsic value that you have calculated is more than the market price, so you must assume that the share price in the near future is going to increase, right? And if you find that the intrinsic value is less than the market price, so it can be assumed or it can be predicted that the share price is going to decrease in the near future. Right, understood? So if you just simply imagine that particular picture or a line that whereby the intrinsic value is at a particular point, and the market price is also at a particular point, and the difference is that intrinsic value is higher than the market price, then it can be predicted that the share price would move up in the near future to reach the intrinsic value. And if the share price is more than the intrinsic value, is higher than the intrinsic value, the intrinsic value lies at a lower point than the market share price, then it can be expected that in the near future the share price is going to get down. So it can be said that the price the shareholders are prepared to pay for a share is nothing but the present value of the dividends they expect to receive on the share, and this is the price at which they expect to sell it in the future. So it can be well understood now that whatever the shareholders are ready to pay for a share is actually the present value of the dividends they are actually expecting in future. So assume that a company is expected to pay a uniform dividend. So this is just one example. It is generally not the case. In reality, the dividend does not remain constant. The dividend fluctuates, or if it is a growing company, basically dividend increases. So for the time being, let us assume that if the dividend is constant, that is D1 for the first year, for the second year, for the third year, and so on and so forth, the dividend is constant, then we can evaluate the present value as such. P naught is equal to d divided by 1 plus k plus d divided by 1 plus k square, d divided by 1 plus k whole cube, and plus and so forth. So here we can assume that the dividends are constant and we are discounting it with a rate that is k. Here the discounting factor is k. So it can be the expected rate of return, or it can be any other rate at which you expect your cash flows to be discounted. That is the opportunity cost. Now, like I have said, it is generally unrealistic to assume that the dividends will remain constant forever. So in most cases, the dividend per share grows because of the growth in the earnings of the firm. So since you are already assuming that the firm is going to give you more dividends, so it is generally true that the dividends shall be growing if it's a growing firm. So most companies, as they identify new investment opportunities for growth, tend to increase their DPS, that is dividend per share. So if the company is growing the dividend, the per share dividend would definitely grow. So assuming that on an average, the DPS of the company grows at a compounded rate of G. I should have bolded this point. Compounded rate of G per annum, then the dividend D1 at the end of the first period grows to D into 1 plus G. So if the first period the dividend was D1 or D, then at the end of the period and the first P period, since the company is giving an additional, each year it is going on giving a compounded rate of G, then at the end of the first period, that D1 becomes D1 into 1 plus G. Then in the upcoming year, at the end of the second year or at the beginning of the third year, the same dividend would grow into D1 into 1 plus G whole square. And it goes on continuing like this at the end of the third period and the fourth period respectively. So that particular equation can be seen here in this particular slide, where P naught is equal to, for the first year it is D1, so D1 divided by 1 plus K, plus in the next year it is D1 into 1 plus G divided by 1 plus K whole square because it's second year. Then plus D1 into 1 plus G whole square divided by 1 plus K whole cube. So this goes on for the upcoming number of years until the time you think of holding the share. So this is one way of understanding how the present value can be calculated, or how the intrinsic value can be calculated of a particular share, considering in the previous case that considering the dividends were constant, and in this case the dividends are growing at a constant rate, that is G per annum. And this is how you calculate the intrinsic value and try to understand whether the share prices are going to get down, or no, sorry, the share prices are going are in the future the share prices are going down or increasing. So the growth rate in dividends G is less than the desired rate of return on share K. We must have this particular equation. P naught is equal to D1 divided by K minus G. You have seen this particular formula, you have used this formula or equation while studying business finance or financial management, because it is known as the Gordon's dividend growth model for stock valuation. You have learned this formula or equation. This is used by the fundamental analysts to understand the value of the share. So here this equation is used if the growth rate in dividend, that is G, is less than the desired rate of return, that is K. So if G is less than K, expect if G is, that is growth is less than the expected rate of return, then this equation is used. This is a famous equation which was proposed by Gordon. So let's move on to the dividend growth model and the PE multiple. So financial analysts, like, there are various factors now which can be associated with the share price. So financial analysts tend to relate price to earnings via the PE multiples. PE multiples means the ratio between the market price and the earnings per share. That is MPS divided by EPS. That is the PE multiples. If a company is assumed to pay out a fraction B of its earning, so you must assume that it is not possible for the company to let out each and everything that they have earned as profit to its shareholders. So some of the profits are retained back, which is termed as retained earnings. You have learned this in financial management. So only part of the profits are let out, or sorry, part of the profits are distributed among the shareholders as the dividends. So if a company is assumed to pay out a fraction B of its earnings as dividends on an average, that is the dividend payout ratio is equal to B, then this D1 in the previous thing in the D1, that is in this D1 can be expressed as B into EPS, where EPS is earning per share of the company at the end of the first period. Then the equation shall be given as P naught is equal to B into EPS divided by K minus G. So this same equation, if this D1 is actually a particular fraction of the earnings, that is B, then it can be expressed as uh, B into EPS divided by K minus G. We come to the end of this particular lecture. We shall be continuing from this point only in the upcoming video. Thank you so much.